Right now, Spruce Biosciences is trading at $173.60 per share, down $1.71 or just under 1% on the day. Now, seeing a single-digit move like that might seem unremarkable, but it's the quiet after a storm that tells the real story. The expectation for a stock like this, especially after the seismic shift it experienced, is that the narrative is settled. The market has supposedly priced in the massive success of its recent data, and now we're just watching the paint dry. The reality is far more complex. The current stability is deceptive. It masks a fierce battle between institutional accumulation, retail profit-taking, and short sellers testing the new floor. What's happening beneath the surface is a recalibration of what this company is actually worth, and it has very little to do with today's minor fluctuation. Most investors looking at Spruce see a classic biotech story arc. A small company with a promising drug candidate for a rare disease, in this case, tildacerfont, for congenital adrenal hyperplasia. The common belief is that the recent positive Phase 2 data was the big moment, the event that de-risked the asset and set it on a clear path to approval and commercialization. It's an easy narrative to buy into, especially when you see the stock price multiply itself many times over in a short period. Many traders on platforms like Robinhood and SoFi Invest likely saw the initial surge and jumped in, expecting the momentum to continue indefinitely. They see a chart that went vertical, and the expectation is for more of the same. But that's a surface-level reading. The deeper reality is that the pivotal data is still to come. The market has priced in a significant degree of success, but it has not fully accounted for the nuances of the upcoming Phase 3 trials, the specific endpoints the FDA will scrutinize, or the competitive landscape that is quietly taking shape. The recent surge was the market's reaction to crossing a critical checkpoint, not finishing the race. Let's break down the recent trading activity because it tells us so much. The initial explosion in price was driven by an incredible surge in volume. We're talking about tens of millions of shares changing hands, compared to a daily average that was previously in the low hundred thousands. This wasn't just retail enthusiasm, this was a massive institutional re-rating of the company. Funds that couldn't build a meaningful position before the data suddenly had to get in, and they were willing to pay almost any price. You could see this reflected in the order books on platforms like Interactive Brokers, which offer deeper market data. The bid-ask spread was wide, and large block trades were executing well above the prevailing price, a classic sign of aggressive, informed buying. However, after that initial peak, the volume has started to normalize, and the price action has become more of a tug-of-war. This is where the story gets interesting. The slowing volume suggests the large funds have built their core positions. Now we're seeing a different kind of activity. There are day traders and swing traders, perhaps using the Fidelity mobile app or other accessible online investing tools, trying to scalp small profits from the volatility. There are also the original long-term holders who are now faced with the decision to take life-changing gains off the table. This selling pressure is being met by a new wave of buyers who missed the initial run-up and are now trying to get in on what they perceive as a dip. This creates the choppy, sideways price action we're observing. It's a period of consolidation, and the direction it breaks from here will be incredibly telling. The risk for those engaging in self-investing is misinterpreting this consolidation as a stable base, when it could just as easily be a prelude to a significant correction if any doubt creeps into the narrative. So what exactly does Spruce Biosciences do? The company is focused on developing novel therapies for rare endocrine disorders. Its lead candidate, tildacerfont, is a once-daily oral antagonist of the CRF1 receptor. In simple terms, it's designed to reduce the body's overproduction of adrenal androgens, which are the key drivers of the symptoms in patients with classic congenital adrenal hyperplasia. CAH is a genetic disorder affecting the adrenal glands, leading to hormonal imbalances that can cause significant health issues throughout a person's life. The current standard of care involves glucocorticoid therapy, which comes with a host of serious side effects from long-term use. Spruce's goal is to provide a treatment that can significantly reduce a patient's reliance on these steroids, thereby improving their quality of life. The business model is straightforward, but high stakes. Pour resources into clinical development, achieve regulatory approval, and then commercialize a first-in-class or best-in-class therapy for a patient population with a high unmet need. This is the kind of focused, specialized approach that large wealth management divisions at places like Fidelity Wealth Management look for in their speculative biotech allocations: a clear target, a novel mechanism, and a defined market.